Here's a number that should bother you. If you own an S&P 500 index fund, VOO, SPY, whatever, and the market is up 12% for the year, you probably think there's nothing to do. Market's up, good year, move on. But underneath that, up 12%, something like 150, 200 of those 500 companies are actually down for the year. Down double digits, some of them. You just never see it because the fund wraps all 500 into one price and hands you the blended number. And here's the part that costs you money. Inside that ETF, you can't touch those losers. You can't harvest them. They're locked in a box. The fund owns them. You own the fund. Direct indexing breaks that box open. Same index, same return, but instead of owning one fund that owns 500 stocks, you own the 500 stocks directly. And when 150 of them are red, even in an up year, you get to do something with that. Today I'm going to show you exactly what that machine is and how it works, how it keeps your Roth conversion taxes low, how it can neutralize the tax bomb on a business sale or a giant slug of company stock, how the strategy has evolved from a rich person only product into something that runs on autopilot for a lot less, and most importantly, where it actually belongs in your retirement plan and where it absolutely does not. I'm Ryan Knoll. This is The Bracket, the show about managing the one variable in retirement most people ignore, the tax bracket you're standing in. Let's get into it. Let's define the thing cleanly because the name is worse than the concept. A regular index fund, you give Vanguard your money, Vanguard buys all 500 stocks in the S&P 500, and they hand you a single share that represents a tiny slice of all of them. Cheap, simple, tax efficient at the fund level, nothing wrong with it for most people. Direct indexing, though, is instead of buying the fund, you buy the stocks directly. It's a separately managed account, an SMA. You hold the actual individual companies that make up the index. Apple, Microsoft, a couple hundred names weighted to track the index within a tight tolerance. You're not trying to beat the S&P, you're trying to become the S&P share by share. And you can do this with other indexes as well. It doesn't have to be the S&P 500. It could be mid-cap stocks, small-cap stocks, tech stocks only. You name it, you can build it. So why on earth, though, would you take on the complexity of owning 200 plus stocks instead of one clean fund? There's one reason and one reason only. Losses live at the stock level, and you can only harvest what you own directly. Go back to the open. Market's up 12%, but Nike's down 20. Some energy name is down 15, and a healthcare stock just got cut in half on a bad trial. In the ETF, those losses are invisible and untouchable. In a direct index, the software sees that Nike lot is underwater, sells it, books the loss, and immediately buys something highly correlated, a competitor, a sector peer, to keep your market exposure identical. You never skip a beat on returns, but now you've got a realized capital loss sitting in your account ready to work for you. That's the whole game. You capture the volatility of the individual stocks while keeping the return of the index. Now, how much loss are we talking? This is where I want you grounded in real numbers, not marketing. A long-only direct index, just the stocks with no fancy leverage, can typically generate cumulative realized losses of roughly 30% of your initial investment over the first several years. Think 3 to 5 years. Put $1 million in, and you might bank around $300,000 of harvestable losses over that early window. It front loads. The biggest harvest is in the first 2 or 3 years when your cost basis is fresh and lots are more likely to dip below what you paid. What we see in the median scenario is about a 7% loss harvested in year 1. In year 2 tends to be roughly in line with that as well, and then over time, as the investments grow, the opportunity for harvesting losses goes down. And I want to be honest about a real-world comparison here. One large advisory platform published their 2025 ETF-only tax loss harvesting portfolios harvested about $4,800 in losses on average. while the portfolios that added direct indexing harvested $18,000. Call it 3 to 4 times more harvestable losses in the same market. That's the edge quantified, last year's actual numbers. But here's what you have to burn into your brain because it's the thing bad advisors gloss over. This is a deferral strategy, not a magic elimination strategy. When you harvest a loss and buy a replacement stock, your new stock has a lower cost basis, and you're lowering the basis, which means a bigger gain later. You are pulling tax benefit forward and pushing tax liability into the future. That trade is enormously valuable. Deferral plus compounding plus rate arbitrage is real money. But if a salesperson tells you direct indexing makes taxes disappear, they're either confused or lying. It defers, it arbitrages, it gives you flexibility, it does not erase. Hold that thought because the exit is where this whole thing gets interesting, and we'll come back to it. All right, point number 1 from a lot of you in the comments is how does this help with my Roth conversions? This is my favorite use case, so let me build it carefully. If you've watched the earlier episodes, you know the Roth conversion corridor, the window, usually in those early retirement years before Social Security and RMDs begin, where your taxable income drops into a valley and you can convert traditional IRA money to Roth at a low bracket. Fill up the 12% and 22% brackets, pay the tax now at a discount, and never pay tax on that money again. The problem every single person runs into, the conversion is ordinary income, and it stacks on top of everything else. Every dollar you convert pushes your total income up. And when your income goes up, 3 ugly things can happen at once. You climb into a higher bracket, you can trigger IRMA surcharges on Medicare down the line, and if you're an early retiree on ACA Marketplace plan, you can blow through the subsidy cliff. We did a whole episode on that tax stack. So the constraint on your conversion isn't how much do I want to convert, it's how much income can I absorb before I trip one of those wires. And here's where direct indexing changes that math. A harvested capital loss sitting in your taxable account, capital losses first offset capital gains. But if you've got losses left beyond your gains, you can deduct up to $3,000 against ordinary income every year and carry forward the rest indefinitely. Now, $3,000 a year on its own is not going to change your life. So let me show you the real mechanism because it's more powerful than the deduction. The bigger play is this. Your direct index account is throwing off losses that soak up other income and gains that would otherwise be crowding your conversion room. Picture it. You're retired, living partly off your taxable brokerage account to fund your lifestyle. You're selling appreciated positions, and every sale throws off a capital gain. That gain eats into the income headroom you wanted to use for your Roth conversion. Every dollar of realized gain is a dollar you can't convert without pushing into the next bracket or tripping IRMA or the ACA cliff. But if your direct index engine is continuously harvesting losses, those losses cancel out the gains from funding your lifestyle. Net capital gain drops towards zero, which means the income room you were saving for conversions stays open. You get to convert more at the lower rate because your investment income isn't competing for the same bracket space. Let me put numbers on it. Say your plan is to convert $80,000 this year to stay at the top of the 22% bracket, but you also need to sell taxable investments to live, and that generates $40,000 of realized capital gains. Without harvesting, that $40,000 stacks onto your income, and now you're either converting less, spilling into higher ordinary income or capital gains brackets, and flirting with IRMA. With a direct index account that harvested, say, $40,000 in losses this year, those losses wipe out the gains. Net investment gain is roughly zero. Your full $80,000 conversion fits cleanly under the ceiling you set. That's the connection. Direct indexing doesn't lower the tax on the conversion directly. It simply clears the runway around the conversion so you can do more of it in the bracket you want. And here's the compounding kicker. Every dollar you successfully move into Roth is a dollar that will never generate another taxable required minimum distribution, never inflate IRMA again, and never push a future tax bill. So you're using a taxable account tool to accelerate the drawdown of your pre-tax accounts. The two strategies feed each other. The harvest protects the conversion permanently shrinks the future tax problem. There is one guardrail, and I want you to say it with me. Watch the wash sale rule. You cannot harvest a loss and buy back a substantially identical security within 30 days. A good direct index platform handles this automatically by swapping into a correlated but not identical stock. But if you're also buying that same S&P 500 index in another account, your 401k, your spouse's IRA, you can accidentally trigger a wash sale and blow up the harvest. This is exactly the kind of thing that needs to be coordinated across your whole household, not run in a silo. It's a big reason this belongs inside a real plan and not bolted on by itself. Quick pause. If you're sitting there thinking, okay, but where's my conversion window? And is direct indexing even worth it for my situation? I built a free tool exactly for that. It's the Income Architecture Blueprint. Answer a handful of questions. It maps your bracket situation and flags whether these strategies actually move the needle for you. The link is in the description. It's free, and it takes about 3 minutes to go through. Go grab it, then come back, because the next part is where the really big money lives. This is point 2, and honestly, this is the segment that can be worth 6 or 7 figures to the right person watching, so lean in. Some of you have a giant taxable event coming. You're selling a business. You've got a mountain of company stock, whether it's from RSUs, options, or your employer stock purchase plan from 20 years at one employer. You're selling a home that's appreciated way past the $250,000 or $500,000 exclusion, whether you're married or single. Whatever it is, you've got a one-time gain heading at you like a truck, and the tax bill on it is going to be brutal. Here's the strategic idea. You can spend years building up a stockpile of harvested losses and then unleash them in the year of your big event to crush the gain. Think about the timing. You know the business sale is 3, 4, 5 years out. Starting now, you run a direct index account, ideally an aggressive loss optimized one, and you continuously banking realized capital losses. Those losses carry forward year after year, piling up. Then in the year you sell the business and realize a massive long-term capital gain, you've got a warehouse of accumulated losses ready to offset it dollar for dollar. You dramatically reduce, sometimes even eliminate, the capital gains tax on the event. And the beautiful part, the whole time you were stockpiling those losses, you stayed fully invested in the market. You didn't sit in cash waiting. You captured the market's return and built the tax shield at the same time. That's the thing that makes this different from just saving up for taxes. You're not giving up growth to get the protection. Now let me go one level deeper, because this is where the strategy has genuinely evolved, where it gets powerful for concentrated stocks specifically. A plain long-only direct index caps out. Remember, about 30% of the principal in cumulative losses, and it slows down as the account ages and everything you own is now sitting on a gain. The industry calls that an ossified portfolio. It runs out of losers to harvest. That 30% is often not enough to fully offset a truly enormous event like a $5 million business sale. Enter the long-short version. You'll hear it called the tax-aware long-short or the 130-30 strategy, or the leverage could be even bigger than 130-30. It could be 200-100. Here's the concept, though, without the jargon. The manager uses your portfolio as collateral, borrows to buy extra stocks on the long side, and sells an almost equal amount of stock short. Your net exposure to the market stays right around 100%. So you still get market-like returns, but now you've got positions on both sides. In an up market, your shorts lose and you harvest those. In a down market, your longs lose and you harvest those. You're generating harvestable losses in basically any market environment, not just down years. How much more? The research is pretty striking. A 130-30 long-short portfolio has been shown to generate roughly 2.7 times more capital losses than a long-only portfolio over 10 years. That's the difference between offsetting a chunk of your business sale and potentially offsetting the whole thing. In the median case, we see it almost double year one losses compared to the long-only strategy, harvesting roughly 13% on the initial contribution. There's a specialized flavor for the concentrated stock people. Say you're the executive with $5 million of company stock, cost basis of basically nothing, and you're terrified to sell because the gain is enormous. A long-short loss harvesting strategy can diversify you out of that position tax neutrally over time. The harvested losses from the rest of the portfolio offset the gains as you trim the concentrated position, so you diversify without writing a giant check to the IRS. Research on this shows a fast diversifying version can knock a single stock down from a dangerous concentration to a reasonable 5% weight within about 5 years, in the large majority of scenarios tested. Compare that to just selling. A $5 million gain spread over that period could mean realizing hundreds of thousands in taxable gain every single year. The long-short approach cuts through that. In fact, I want to walk you through how we are using a long-only strategy with a current client and how we're complementing it with a long-short strategy as well. This client, let's call him Bob, and his wife Lisa, and they're selling their business. They are selling half of it now and half of it 5 years from now. And when they sell their business, they will realize roughly $4 million in gains now and another $2 to $3 million in gains when they sell the rest. So we just met them this year, the first year of the sale. They are staring down the barrel of $4 million in gains, which is nearly a $1 million tax bill when you factor in 20% for capital gains and another 3.8% for net investment income tax. Luckily, they live in a no-tax state, or we would have to add that in as well. So right now, we're using a 130-30 portfolio for the current year to harvest as many losses as possible. We started this around the end of Q1, so if they have the median performance, they will harvest an estimated 10% of losses to account for the shorter time frame. On their initial $1.5 million investment, that's roughly $150,000 of losses. That $150K will offset the gains and save them roughly $36,000 in taxes. Now, that's not a huge amount, but we are working with little time. The real value will be how we prepare for the other event 5 years from now. Over the next 4 years before the final sale, Bob and Lisa are going to add to this account and a long-only direct index, roughly $125,000 each quarter into each strategy, or $500,000 a year allocated to each. We are trying to book as many losses as possible while still growing the funds to help with that huge tax bill down the line. We estimate that if we just find the median performance with this strategy, the 130-30 portfolio will generate roughly $300,000 in losses, and the long only will generate an additional $110,000. That is $410,000 total to offset future gains, which would have been taxed at 23.8%. Rough estimated savings of about $98,000, just assuming the median performance. But now I have to put my fiduciary hat on and be straight with you, because this is where people get sold something they shouldn't buy. Long short is not free lunch. It uses leverage and shorting. That means real risk, tracking error, meaning your return can drift from the index up or down, higher fees, and genuine complexity. And here's the trap almost nobody mentions. Because it's a deferral strategy, it's hard to get out of. As the account matures, everything you hold is sitting on gains. If you try to fully unwind and take the leverage to zero, you can trigger a wave of taxable gains that claws back most of the benefit you spent years accumulating. So the exit strategy is everything. The two clean exits are, 1, you can use the losses against the big event you planned for. That's the whole point. Or 2, and this is the quiet one, you hold until death and let the step up in basis wipe the slate clean. Under current law, your heirs inherit at fair market value, and all that embedded gain you deferred just evaporates. Deferral becomes elimination at the finish line, which is exactly why I said earlier, this is a deferral machine, and the exit is where it either pays off or blows up. If you build a giant deferred gain, long-short portfolio, and you don't have a plan for the exit, with no big offsetting event, no step-up runway, you've just built yourself a slow-motion tax bomb with extra fees attached. This strategy has to be married to a plan, full stop. For our clients, Bob and Lisa, we have one more trick up our sleeve. We are going to donate the appreciated positions to charity via a donor-advised fund this year and when the other half of the sale is completed. This is the money they were planning on giving anyways, so we are going to give more in those 2 years to claim even more of a deduction for taxes on money they were planning on giving anyways. Whatever remains will grow in an account that will ultimately be given to their kids who will receive the step up in basis at that time. Point number 3, and I think the history actually matters here because it tells you where the value is and where it's repackaging. Chapter 1 is stock only, ultra high net worth only. Direct indexing isn't new. Firms like Aperio and Parametric pioneered this back in the day, running separately managed accounts with individual stocks that tracked an index and harvested losses. But it was expensive, labor intensive, and the minimums were huge. This was a several $1,000,000 account product. Rich people only. The reason was pure friction. To own 200 or 300 stocks, you had to place hundreds of trades, and every trade cost a commission. Do that across thousands of client accounts by hand, and it's economically impossible for normal portfolios. Chapter 2, the plumbing changed and it went mainstream. Two things collapsed this barrier. First, zero commission trading. When the cost per trade went to nothing, owning 500 stocks stopped being expensive. Second, fractional shares. Now a $100,000 account or even less could hold a real tracking slice of 100 plus names instead of needing millions. Add modern software managing thousands of accounts at once, and direct indexing dropped from a millionaire's toy to something available at account sizes of around $100,000 and now even lower. That's the version most of you would actually encounter today, an ETF plus direct index hybrid, where the biggest chunk of your equity is held in individual stocks you're harvesting, and the harder to hold corners, small caps, international, are filled with a cheap ETF. And then there's Chapter 3, which is custom indexing. Once you own the individual stocks, you can customize. So if you don't want any more of your employer's stock because you're already overexposed, screen it out. Want to tilt towards value or dividend players or screen out sectors you object to? You can do that too. The index became a starting point instead of a cage. That's the custom indexing language you'll hear now. Chapter 4, and this is where we're at today, the long, short, and tax-aware overlays. This is the frontier we covered in the last segment. Removing the long-only constraint, letting the strategy short stocks, was the big leap because it untethered lost harvesting from needing the market to go down. It also lets a strategy revitalize an ossified portfolio, meaning it can breathe new loss harvesting life into an old account that had run out of losers. This is the cutting edge. It's the highest fee, highest complexity version, and it's genuinely powerful for the right situation and genuinely oversold for the wrong one. So the arc is stock only for the ultra wealthy, to zero commissions and fractional shares, brought it to the mass affluent, then custom indexing added personalization, and the long-short strategy added the ability to harvest in any market. Each step added capability, and be honest about it, added cost and complexity. More sophisticated is not automatically better for you. It's better for the person whose situation demands it. All right, point 4. And this is the one that actually matters because everything before this was mechanics, and this is the judgment. Where does direct indexing belong in a real retirement plan, and where does it not? First rule, it only works in a taxable account. This is the one that trips people up constantly. Tax loss harvesting is meaningless inside an IRA, a Roth, or a 401k. Those accounts don't tax gains or recognize losses year to year. So if the bulk of your money is in pre-tax retirement accounts and you have a small taxable brokerage, direct indexing has a small canvas to work with. The size of your taxable account is the size of the opportunity. Be realistic about that before anyone sells you the deluxe version. Second, you need gains for the losses to offset now or on the horizon. Harvested losses are only worth something if you have capital gains to cancel them out, or the big future event we talked about. If you're a straightforward retiree with a modest taxable account and no giant gain coming, you're not doing aggressive Roth conversions. The losses mostly just drip out at $300,000 a year against ordinary income. And that's fine, but does not justify the fees and complexity of a long-short product. Match the tool to the need. Third, and here's my actual framework for who this fits. The person direct indexing genuinely helps. You've got a substantial taxable account. You're in a high bracket while working, or you have big realized gains flowing through, you're running aggressive Roth conversions in your early retirement and need to protect the headroom, or you have a large known event coming, the business sale, the concentrated stock, the property. For those people, this is a serious wealth tool, and I'll put it in plan all day. The person who should not get talked into this, most of your money is in pre-tax accounts, your taxable account is small, you have no big gains and no big event, and you value simplicity. For you, a plain, low-cost index ETF is not the consolation prize. It's the right answer. You capture the same market return with a third of a basis point of cost. No tracking error, no leverage risk, and no exit problem. Fourth, sequencing inside the plan. If it does fit, think about when. The ideal setup is to establish the direct index account before your big harvest years and before the big event. You want a fresh cost basis and runway to accumulate losses, and you want it coordinated with your conversion strategy and your withdrawal sequence so the wash sales don't collide and the losses land in the years you actually need them. This is not a set it and forget it product. It's a component that has to be timed and integrated. And fifth, never forget the exit. I'll say it a third time because it's that important. A direct index account, especially a long short one, builds up deferred gains. You need a plan for how those gains get resolved. Offset by your planned event, bled off gradually in low-income years, or carried up to the step-up in basis. If nobody's talking to you about the exit, nobody's actually planning. They're just selling you the entry. So let's bring it home. Direct indexing is, at its core, a simple idea wearing a complicated coat. You own the stocks instead of the fund, so you can harvest the losers even when the index is up. And you turn ordinary market volatility into a stream of tax benefit while keeping the market's return. Used right, it protects your Roth conversion window by soaking up the gains that would otherwise crowd it out. It can diffuse the tax bomb on a business sale or a pile of company stock while keeping you invested the whole way. It's evolved from a millionaire's toy into something a lot of you can actually access. And at the frontier, the long-short version can harvest in any market and diversify concentrated positions almost tax-free. But it is a deferral strategy, it's not a miracle. It only works in taxable accounts. It needs gains to offset, and the exit, the business sale, the low-income drawdown, the step up at death is where it either pays off or turns into a bomb. The mechanics are impressive. The plan around them is what makes them worth anything. That's the theme of this whole show. It's never about the one clever product. It's about the bracket you're standing in and how every piece fits together to keep you in a low one. If this helped, and you want to know whether direct indexing actually moves the needle in your situation, not a generic yes, an actual answer for your numbers, grab the Income Architecture Blueprint in the description or book a call with our team. The link's down there too. We do this for high net worth households getting within a decade of retirement. And this exact analysis is the kind of thing we build for every one of them. I'm Ryan Knoll. This has been The Bracket. Manage the bracket, keep the money. See you in the next episode. That's it for this episode of The Bracket. If something here made you rethink a decision you were about to make, that's the whole point. Go deeper before you act. And if you want help applying any of this to your own situation, the team at Nav Wealth Partners does exactly this work. Tax strategy for the distribution years, for households like the one this show is built for. There's a link in the show notes to schedule a conversation with one of our advisors. Click to see if you're a fit. And if this episode was useful, do me one favor. Follow the show and leave a rating wherever you're listening. It's the single biggest thing that helps another retiree with the same questions actually find us. Quick but important note. Everything on this show is educational and for general information only. It is not personalized investment, tax, or legal advice. And listening does not create an advisory relationship with Nav Wealth Partners. Nav is a registered investment advisor. Your situation is your own. Please consult a qualified professional before acting on anything you heard here. I'm Ryan Knoll. Thanks for listening to The Bracket.